Yeah, I think we are live. So again, yeah, we are live now. Hello, students. Those of you who would be joining us on YouTube, welcome to day 5 of the revision session that we are conducting for CA Foundation. Right. So far we have covered admission related aspects, goodwill related aspects. We have covered aspects relating to sacrifice ratio. Now today we'll be specifically covering about some aspects especially which are linked to your retirement and death of a partner. And one such topic where we have seen multiple queries from the students where they get some doubts is a joint life policy. Before I go into joint life policy, let us understand what is a policy or an insurance policy. Okay, so there would be an insurer and there would be someone who is called the insured. So say for example, you take a policy on your vehicle. Okay, so there is an insurance company called say ICICI Lombard, and you are the insured. What have you insured? You have insured, let us say, your two-wheeler. And if at all there is any accident, or if at all if there is any accident that involves your two-wheeler and your two-wheeler gets damaged, and for that you have to incur certain expenditure, that amount will be given by the insurer. That is what is the insurance policy. These policies we call general insurance policy. Similarly, you have health insurance policies where if at all you get hospitalized, insurance company would pay the hospital bill. You also have something called as life insurance. Okay, life insurance are, one is term insurance, other one is endowment policy. I'm going slightly fast because these are general concepts that you would be aware of. Now, the purpose of life insurance is to ensure the life of a person. So say for example, if one person, let me say Mr. A, if Mr. A has taken a life insurance, okay, and if let us say due to unforeseen circumstances he dies during the policy coverage period, okay, then what happens is on death the sum assured is paid to the nominees. Okay, that is what is a life insurance. Now in term insurance, only when the person dies you get the money, that is the nominees get the money. In endowment policy, the money is received, so this is only on death. This is on death or maturity. Okay, so a lot of policies you may you can ask your parents also, they would have taken life insurance policies from LIC. Most of the life insurance policies issued by LIC are endowment policy, that is the sum assured will be given on death or maturity, whichever is earlier. In these days, and generally what I would also prefer is to have a term insurance rather than endowment policy, because insurance should be separate, investment be separate. So term insurance gives you money on death. Okay, now what is this joint life policy? Joint life policy is basically taken on joint lives. Joint lives meaning if there are husband and wife, they can have a joint life policy, or there are partners in a firm A, B, C. These three partners can take a joint life policy. They can take a joint life policy which would cover the lives of the partner. Now, what is the meaning of covering the lives of the partner? What it basically does is, if one of the partners dies, say for example A died, when A dies, what all will happen in the partnership firm? Can you tell me? When A dies, unfortunately, what all would happen in the partnership firm? What all are the accounting formalities? What all are the settlement formalities?
They will settle the accounts based on whatever, then they'll give to their legal representatives.
Okay, so there
revaluation of assets and
revaluation.
You will do the revaluation of asset. Okay, then
we'll give the share of goodwill.
So there will be a share of goodwill that you have to give to the partner. So basically, on the firm there is a liability which comes up. So there are three partners. Let us say 1 lakh. 1 lakh. This is the capital. Okay, I'm just talking about the capital. If one partner dies, you suddenly have to give 1 lakh to the nominees of that particular partner. So to ensure that the business is not disrupted, what the partners can do is they can take a joint life policy which will cover the life of the partner. Okay, and this joint life policy, so there, please understand, there is something called a beneficiary and insured. Insured are the lives of all partners. Beneficiary would be the partnership firm. Meaning to say, if A dies, whatever is the sum assured will be given to the partnership firm. Whatever is the sum assured will be given to the partnership firm. Now, if it is a endowment policy, if it is an endowment policy, even if nobody dies and the policy matures, amount would be given to the firm. So please understand this. Generally, and the type of questions that are tested in the exams, when we say joint life policy, JLP, for our exam purpose, most of them are endowment policies. Endowment policies means what? Endowment policies means what? Endowment policies mean that either on death or maturity, you will get the money back. Either on death or maturity, you will get the money back. Who will get the money back? The partnership firm will get the money back. When the partnership firm will get the money back, that will of course be distributed amongst the partners. Okay. Now on death, you will get the full value or sum assured. Okay. On maturity, also you will get full value or sum assured. Now sometimes what happens is the partners may decide that they do not want the policy. So I've taken a policy for 5 years. Say for example, I've taken a policy for 5 years, and after 2 years, I realize that I don't need this policy. So what I tell the insurance company, you please take this policy back. I want to surrender this policy. So before maturity, you can surrender. So when you surrender a policy, you will not get the full value of sum assured. You will also not get the full amount of premium paid. What you will get is some amount of premium paid. It depends on the formula. So the question will tell you that if there is a surrender that has happened, you will receive some amount of money. Okay. Now, when can this scenario appear, or when can this scenario happen? Before maturity, if there is a retirement. So say for example, A, he didn't die. A retired. When A retires from the partnership firm, what will A want? A will want the money to come back. Whatever is his share, he will want to take that away. And apart from that, A will also want to claim this policy amount. Whatever is the value of the policy, claim this policy amount from the partnership firm. So at that point of time, the policy will be surrendered because A is no longer a partner. It was taken on the lives of A, B, and C. If A is no longer a partner, either he died or he retired, then this policy will also no longer be in existence because it was taken on 3 lives. Now, how many lives are left? Only 2 lives are left. So the policy will have to be surrendered if there is a retirement. If the person dies, if the partner dies, then there will be a claim that will happen and the entire sum assured will be received by the firm. Okay. Now, so far, are you clear with the underlying concept of JLP?
Yes, sir.
Yes.
Okay. Any question here? Any doubt?
No, sir.
Yes.
Huh?
Yeah.
Yeah, tell me. Any doubt?
No, sir.
Okay. So now to take this policy, you have to pay annual premium. Take the policy, you have to pay annual or monthly premium, whatever it is. Let us assume you have to pay annual premium. Now I'll give you a very simple example. 3 partners, sum assured is 1 lakh. Meaning to say, on the death of any of the partners, the firm will receive 1 lakh. That is one thing. Then annual premium is say 20,000 and term is 3 years. Okay. So 20,000 you pay for 3 years, you get coverage for sum assured of 1 lakh. So even after the end of the first year, you just pay 20,000, and if one partner dies, then you get 1 lakh from the insurance company. Okay. Now, this premium that I'm paying, insurance premium that I'm paying, it is generally treated as an expense. Most of the cases, insurance premium is treated as an expense because, if you have taken a term policy, you'll not get the money back. In endowment policy case, you will get the money back. That is one aspect. But generally, you will treat it as an expense. Insurance premium is generally treated as an expense. Okay. Now, as far as partnership accounts are concerned, there are ways to value some asset in respect of this joint life policy. That I'll come to it slightly later. But first, understand that when I'm paying in year 1, 2, and 3 premium, how much? 20, 20, 20. Normally, this will be expense. Expense to what? P&L. Okay. When you expense the premium paid to P&L, will there be any asset in the balance sheet?
No, sir.
I'm again repeating my question. When you charge the premium paid as an expense, premium, insurance premium, debit, 20,000 to bank, 20,000, and this insurance premium is debited to P&L, 20,000, to bank, 20,000. Is there any asset in the balance sheet in this case?
No, sir.
No.
No, right? So there is no asset in the balance sheet in this case. Now, assume for a moment that in the first year itself, or in the beginning of the second year, you paid the first premium. This is paid in year 1. Okay. When this is paid in year 1, we said there is no asset in the balance sheet because the premium is expensed. Now, tell me one thing. If at the beginning of second year, A died. If at the beginning of the second year, A died, then what is the amount that the insurance company will pay to the firm?
1 lakh.
1 lakh. 1 lakh or
1 lakh.
20,000?
1 lakh, sir.
1 lakh. So insurance company will pay to the firm an amount of 1 lakh. Okay. Just a second. Now, when insurance company will pay 1 lakh to the firm, then what will happen? You will receive the amount in bank. 1 lakh. What will you do with this amount received from bank?
Credited to P&L.
Credit it to P&L. Is it an item of profit?
No.
It's not an item of my profit. See, what has happened is the 3 partners have taken a joint policy. When they took that joint policy, whatever is the amount of premium paid, that is charged as an expense in the P&L. That is this amount of 1 lakh, they have received an inflow. Some asset has come into the partnership firm, and this asset belongs to the 3 partners. Correct or not?
Yes, sir.
This asset belongs to the 3 partners. So whatever is the amount received, that will be distributed to A, to B, and to C. Say for example, equally. So 1 lakh divided by 3, 33, 33, 33. Are we clear? Here what is happening? Insurance premium paid is treated as an expense. And whenever we receive the amount at the time of maturity, whatever is the amount collected, that will be distributed to all the 3 partners in their profit sharing ratio. Okay. Or if you are getting confused with this, what you can do is when A dies, you receive some amount, bank account debit 1 lakh to joint life policy account 1 lakh. Okay. So basically the firm has received 1 lakh from the insurance company. This amount that is received from the insurance company belongs to the 3 partners. So this joint life policy account you will debit by 1 lakh and credit to A, B, and C by 33, 33, 33. Are we clear? Any doubt in that? Let me see if there is something.
Clear, sir.
Now, in this case, we are not maintaining any asset account. Are we clear? In this case, we are not maintaining any asset account, and we are considering the premium paid as an expense. So premium is considered as expense, and whenever an amount is received from the insurance company, you credit that to a joint life policy account and then distribute that amount to the partners, because these 1 lakh rupees belongs to the 3 partners. Are we clear?
Yes,
Yes,
sir.
sir.
Okay. Now, assume for a moment in beginning of year 2, A did not die. Beginning of year 2, A retires. Now, please note, whenever there is a reconstitution in a partnership firm, this joint life policy has to be cancelled, because you cannot carry on the joint life policy. Maybe you can take a new life policy, but existing life policy will lose its existence. Now, beginning of year 2, A retires. Now, if A retires, what will the firm receive from this joint life policy?
And whatever it is fixed, like not 1 lakh.
They will not.
Surrender amount, sir.
So on that date, they will receive a surrender value. Okay. Assume for a moment, premium paid was how much? 20,000. Insurance company says, I will not pay you 20,000. I'll pay you only 15,000. Sir, what about that 5,000? Insurance company also wants some profit, right? So that 5,000 will be retained by the insurance company, and insurance company says, take this 15,000 and let us cancel this policy. So in that case, what will happen? Joint life policy account, debit 15,000. First you'll receive money, right? So let me just copy this here. Bank account debit 15,000 to joint life policy 15,000, and joint life policy to the partners 5,000, 5,000, 5,000. When A retires, say we need to give A his share of amount in the joint life policy. That is the whole funda about this particular treatment. Are we clear?
Yes, sir.
Yeah, this is the simplest
sir.
one. This is the simplest one in the JLP. Now, complexity arises when JLP is shown as asset in the balance sheet. Sir, why do we show JLP as an asset in the balance sheet? Because in this case, when there is a surrender possible at the end of year 1 or at the beginning of year 2, when you surrendered, you received 15,000. Correct or not? So what the firm did is he paid 20,000. Out of that 20,000, we are anyways likely to get back 15,000. So when we are getting back 15,000, why not treat that 15,000 as an asset? So what happens is 1, 2, 3. Premium paid is 20,000, 20,000, and 20,000. Okay. Surrender value 15,000, maybe 35,000, maybe 60,000 or 50,000, whatever is the amount which is given. Okay. Surrender value may be more, maybe less, depending on the terms and conditions of the insurance policy. Okay. Now here, so let me prepare ledgers. Joint life policy account, year 1 to bank, you pay premium of 20,000. Now, is the entire 20,000 my asset as at the end of the balance sheet date?
No, sir.
How much is my
Only
asset
the
value?
surrender.
Sorry, surrender
Surrender
value.
value.
So my balance carried down is only 15,000. So then what happens to the balance? Balance is treated as an expense, transferred to P&L 5,000. So in effect, what am I doing? I'm saying, see, 20,000 is my payment. 15,000 I'll anyways recover from the insurance company in the worst case scenario. If somebody dies, I'll get 1 lakh. I'll be more happy at that point of time. Not because someone is dying, but because I'm getting 1 lakh. But otherwise also I'll get a minimum of 15,000. So when I get a minimum of 15,000, my net expense, actual expense is only 5,000. Now in some cases, surrender value at the beginning may be 0. If surrender value is 0, then entire amount will be transferred to P&L. If surrender value is 15,000 in our case, then you will have P&L may only 5,000. Okay. So in the next year, you'll have to balance brought down 15,000. Then to bank. How much is to bank? Another 20,000. What is the balance? 35,000. Okay. Now, will I transfer any amount to the P&L in the second year?
No, sir.
No, sir.
We will not transfer because the entire amount is, the entire amount, that is 15 plus 20, is reflected as an asset in the balance sheet. So there is nothing to be transferred to the P&L. Okay. Now assume for a moment, beginning of third year, our favorite partner A died. Now when our partner A dies, what will we get?
Sum assured, sir.
We will get sum assured. Correct? Everybody agreed?
Yeah.
So to balance brought down was 35,000, and we have received. When we receive that amount, what is the entry will pass? When we receive 1 lakh from the bank, what is the entry will pass?
Bank account debit to JLP account.
Account debit to JLP.
Bank account debit to JLP account. So I'll say by bank 1 lakh. Now my asset is worth 35,000 in the balance sheet. I have received 1 lakh from the bank. So balance 65,000 is a gain to the firm. So that gain to the firm will be distributed amongst the 3 partners. So to A, to B, and to C. 65,000 divided by 3, divided by 3, divided by 3. For the 3 partners, will distribute the amount. Are we clear?
Yes, sir.
Any questions on JLP?
No, sir.
No, sir.
Okay, now what is that thing you find challenging in JLP? What is that thing you find challenging in JLP? Arey yaar, no challenge. There will be some confusion, no, where you see that, okay, this area I am not able to understand. No challenge, no doubts.
Sir, where we are writing the JLP amount in the asset side on surrender value,
Correct.
and the partner retires at that time. I'm getting confused at that point.
When the partner retires, you are getting correct. Okay, so at surrender value, now when the partner retires, what is to be done? Correct, that is the question, right?
Yeah.
Okay, so let me share the screen again. Now say for example here, beginning of third year, A did not die. Beginning of year 3, A retired. Now when in beginning of year 3, A retires, what will we get back from the insurance company? Will again, so to balance brought down 35,000, and A retires. When A retires, you will get 35,000 from bank. That is the surrender value. Now, when you get 35,000 from bank, there is no profit, there is no loss, there is no gain that has to be accounted for. Are we getting it? So in effect, what happens is, think of it. The firm paid 20,000 plus 20,000. How much did the firm pay totally? 40,000. How much did the firm get back? 35,000. So there is actually and indirectly a loss of 5,000. Sir, where did that 5,000 of loss go? This 5,000 of loss is already debited to P&L in the first year itself. So further, there will not be any entry that is required. Are we clear?
Yes, sir, I got. Malab, sir, the entire amount will be passed to only when during the time of death of the partner and not anytime else.
No, anytime else it depends. See, let us say if the partner dies in between, before the insurance premium is paid. So basically what you need to compare is, what is that amount we have received from the bank? 35,000. And what is the value of my joint life policy in the books? If the amount I receive is higher, maybe, let us say for example, insurance premium is due at the end of the year. Okay. And the partner died somewhere in middle of the year. And this, instead of 35,000, we got 40,000 or 45,000. So that extra amount will be transferred to the respective partners.
Yeah, okay, sir, clear.
So see, think of it in this way. How much is the asset in my books? How much is the asset in my books? And how much is the amount that I'm getting from the bank? If I get more amount, it is a gain. I'll transfer it to, credit it to the partner's capital account. If I receive less, it is a loss. I will debit it to the partner's capital account. That is what happens when joint life policy account is maintained. Now, if joint life policy account is not maintained, then if joint life policy account is not maintained, I'm not showing any asset in the balance sheet. I don't have any asset in the balance sheet. Instead of that or against that policy, I'm getting 1 lakh or I'm getting 35,000. Entire amount is my gain. Think of this JLP as any other asset. Say I have stock of 40,000 in my books. Now that stock is valued at 50,000. That 10,000 is gain, right? Similarly, joint life policy, when it is not there in the books, the asset value is 0. Against that 0 of asset value, I got 50,000 or 1 lakh. Entire amount is gain to be transferred to the partner's capital account. Clear?
Yes, sir.
Okay.
Yes, sir.
Sir, will they like mention in the exam GLP is maintained as an asset or?
Yeah, they will see. One is you can see in the balance sheet. So let us do one thing. Let us take one question. Let us have a look at what kind of questions are given. These are simple entry questions we have already discussed. Red, white, and black shared profits and losses 5:3:2. They took out a joint life policy, 50,000, premium of 3,000 being paid annually, surrender value. This is also similar what we have discussed. So here you see. Here they have mentioned joint life policy at what? 20,000. Means what? Joint life policy is an asset in the balance sheet. Joint life policy is an asset in the balance sheet. Now, information. On 1/1/2020, A wants to retire. B and C agreed to continue 2:1. Joint life policy was taken on 1/1/2014 for 1 lakh, and its surrender value on 31st December was 25,000. Okay, so this balance sheet is as of 31st December, and here the value in the books is 20, whereas the surrender value as on 31st December of 2019 is 25,000. For this purpose, A's retirement goodwill was raised for 1 lakh, that is okay. Sundry fixed assets, 1,10,000. B and C did not prefer to show the increase in asset in the balance sheet. Now, what will you do when B and C will not, show the
Memorandum.
revaluation in the balance sheet? What will we prepare?
Memorandum revaluation.
Memorandum
We prepare
revaluation.
memorandum revaluation account, correct?
Yes, sir.
Okay, so they will not prepare, they will not carry out any revaluation, and also they agreed to bring in necessary cash to discharge 50% of A claim to make bank balance 25,000 and to make their capital proportionate. Proportionate meaning in the ratio of 2:1. Now they have asked us to pass journal entries. Okay, now what has happened? Joint life policy is at 20,000 and surrender value is given to be 25,000, and they have not told us whether the insurance policy has been lapsed or whether the insurance policy will continue. See, the question will clearly mention whether the joint life policy amount has been received or not. Now here, since they have not mentioned, we will assume that the joint life policy amount is not yet received. The joint life policy amount is not yet received. So surrender value of joint life policy is 25,000. In the books, it is at 20,000. So an asset worth 20,000 is now valued at 25,000. So will there be a gain or loss?
Gain of 5,000.
There is a gain of 5,000. Similarly, sundry fixed asset is 80,000. Sundry fixed assets were revalued for 1,10,000, meaning to say 30,000 is gain here. So this 30,000 and 5,000, you can route it through memorandum revaluation account and pass the net entry in the partner's account. Or alternatively, what you can do is, there is another way, table way, because see, here the question has asked us to prepare only journal entries. So one option is to pass the net entry by preparing a table, that is goodwill, revaluation on fixed assets, gain on JLP, 1,35,000, and that you distribute in the gaining ratio. This will be slightly complicated. So what you can do is, revaluation of assets 10,000, or I'll put it here, assets, JLP, goodwill, gain or credit, assets 30,000, joint life policy 5,000, goodwill 1 lakh. What is the total? 1,35,000. Okay. This distribute in old profit sharing ratio. What is the old profit sharing ratio? Five is to 3:2. So this divided by 10 multiplied by 5, this divided by 10 multiplied by 3, this divided by 10 multiplied by 2. So you credit and write off in new profit sharing ratio.
2:1.
2:1. So 135 divided by 3 multiplied by 2, and this divided by 3. And you can just pass the net entry. This is one option, because they have just asked the journal entries to be passed. So you will credit, debit, and debit. Now, a lot of times students tend to get confused while preparing these kind of statements. So simply what you can do is, you can prepare memorandum revaluation. Gain on memorandum revaluation you can transfer to the partners, and again loss on the memorandum, the write back of memorandum you can do in the new profit sharing ratio. And for goodwill, again credit in the old profit sharing ratio, debit in the new profit sharing ratio. Both the approaches are fine. You'll not get such simple questions in the exams. That is a different thing. Okay, so like this is given here, then we'll come to separate life policy later. Before that, let me take you through one exam question. There is some disturbance. If you can mute when you're not talking, it will be helpful. This is admission. Generally, this question comes in 4A, admission. So Jan 21. Let's see what's there in Jan 21. Partners, fixed capitals, death of a partner, goodwill, insurance policy. See. Now this question, if you see question number 4, partnership deed of a firm consisting of 3 partners, P, Q, and R, profit sharing being 2:1:1. Is the screen clearly visible, or do I need to increase the font size?
No, sir, it's visible.
Visible, right, to all?
Yes, sir, visible.
Yeah. If you have any issues, any point of time, please, feel free to tell me or no. Yeah. Fixed capital are given. The partners be allowed on interest at 8% per annum on fixed capital, but no interest to be allowed on undrawn profits or charged on drawing. So only interest on fixed capital is given. Then that upon a death of a partner, the goodwill of the firm to be valued at 2 years purchase of the average net profit after charging interest on capital. So here you will take the average net profit, you will charge interest on capital on that, right? Whatever is the average for 3 years, on that you will calculate 2 years of purchase. Then that an insurance policy of 25,000 each was taken in individual names of each partner. So here 25,000, there are 3. 25,000, 25,000, 25,000. We have not yet come to separate policies, but here it is not a joint policy. On each partner, the firm has taken 25,000, 25,000, 25,000 worth of policy. And who died? P died. Okay, P died. Now, how many policies are there? Hello? How many policies are taken?
3 policies.
3 policies. Who died? P died. Now, when P died, what will happen to P's policy? How much amount will be received against P policy? And what will happen to other 2 policies?
Sir, for peace policy, we will receive the sum assured, sir.
Okay. Then for other policies,
And other policies will receive only the surrender amount.
we'll receive the only surrender amount, because here it's not a joint life policy. Here it is a separate life policy. But who has taken the policy? Firm has taken the policy. Now, when firm has taken the separate life policy, whoever dies on that account, we will receive 25,000 full amount. On other account, we will receive only 20%, that is 5,000 and 5,000. Now, can I say that this entire 25,000 should be given to P?
No, sir, it should be divided among all partners.
Why? I took policy on P's name, no? Why should I divide with other partners?
Sir, because the premium is paid out of the firm's P&L, and so it should be transferred to everyone.
Very good. So 25,000 that will be received from the individual for the individual partners, that also will be distributed amongst the 3 partners, and 20%, 5,000 and 5,000 that is received from other 2 policies, even that will be distributed among the respective partners or amongst the partners who are in the firm. Now, because the premium was charged against the profit of the firm, will there be any asset in the balance sheet?
No, sir.
No, sir. No assets.
There will not be any asset in the balance sheet because just a second, guys. Yeah. Now, when the firm profit is charged against the firm profit, in premium is charged against the firm profit, then asset is not there in the balance sheet. But now we will receive 25,000 plus 5,000 plus 5,000, total of 35,000, and we'll distribute that amongst all the partners. Are we clear with this?
Yes, sir.
And upon the death of the partner, he is to be credited with his share of profits, interest on capital, calculated up to 31st December following his death. Now, this is somewhere students can get confused or students get trapped in the examination. The partner died on 30th of September, and the question says provide interest, everything till 31st of December. So we have to provide the profit share till 31st of December. We have to provide the interest till 31st of December. Share of partnership policy and goodwill will be credited to the deceased partner on 31st December. That will be done. Partnership books to be closed annually on 31st of December. That will also be done. He died on 30th of September, and there is some amount in the credit and all of that. Unrecorded liability of 6,000 was discovered, and it was decided to record it and immediately pay it off. Now, what will be the entry for this? Unrecorded liability was discovered and paid.
Revaluation account to unrecorded liability.
Revaluation account to unrecorded liability. Okay, then
Unrecorded liability to cash or bank.
Okay, or you can directly say revaluation to cash or bank. Okay. Now here the question says you are required to prepare an account showing amount due to P's legal heir as on 31st of December. So though the question is lengthy, the question is not asking us to prepare everything. The question is just saying an account showing amount due to P's legal heir. Now let's see how is it presented. Opening balance given, profit and loss account, your interest on capital, whatever has to be received, that is credited. Share of profit is given, goodwill credit is given, insurance policy 17,500. How did we get this 17,500? I'll just quickly calculate, and or they would have done it niche. I will just here 25,000 and 10 35,000. Out of that, P share is 17,500. That is credited to his account. Okay, are we clear? So the question will clearly tell you what is the adjustment, what is to be done, how we should consider the joint life policy. And if you have any doubt in that, let me know. Otherwise, I'll take up if there is any other, joint death policy.
Sir.
Yes, sir.
Sir, I have a doubt in if there are 3 separate joint life policies and the partner dies, why to cancel the other 2 policies in the other partners?
Okay, so generally what happens is when insurance companies, when they give, your policies, they are generally covering the lives of the partners. Now there could be a situation that we only realize the value of P's policy 25,000, that will be there, 25,000 will come. The firm can continue to show or carry the remaining 2 policies, but the thing here is the value of those policies are not zero. What is the value of those 2 policies? I'm just repeating my part. I think some interruption in between. So there are 3 policies, P, Q, and R. These are separate, right? Sum assured 25,000, 25,000, 25,000. Okay. Now P died. When P died, here I'll receive 25,000. Correct?
Yes, sir.
Now, on Q and R policy, assume for a moment we do not surrender. We do not surrender. Now, if we do not surrender Q and R policy, we will not receive any amount. That is there. But there is some value for this Q and R policy. Yes or no?
Yes, sir.
Q and R policy has some value. What is the value? 5,000, 5,000. So P's legal heir will say, boss, you continue the policy if you want to, but give us our share of our share in this 5,000 and 5,000. You want to continue the policy, don't want to continue the policy, that's a different thing. You give us the share of this 5,000, 5,000. So most of the times what they will do is they may surrender the policy and take a fresh policy. If they don't surrender the policy and they don't take a fresh policy, they continue with the same policy, then you may bring that as an asset in the balance sheet. So what you will do? JLP 10,000 to P to Q to R. So basically you will record the JLP as asset at the surrender value in the balance sheet. Clear?
Yes, sir.
Okay, so let's look at November 19. Here also, I hope I'll get some complex question. Capital, proportion share, goodwill. So there is no JLP here. So JLP, as far as you know, we've seen joint life policy. Yeah. So joint life policy is on the name of the partners. We have seen how the treatment is done. And if there are separate life policy, and if somebody retires, you'll only take the surrender value. And the logic we have understood why we should take the surrender value of all the partners as policies, because the partner who is retiring or the partner who has died, the nominees of that partner, the partner who has died will not come back. The nominees of those partners will say, please give us our share in the value of the joint life policy. So that is the reason why whatever is the surrender value, at that value you will take in the credit in the partner's capital account. Now here, assume for a moment, in this case only, I'm just modifying the question. JLP was shown as asset in books at 15,000. Okay, and I want all of you to pay utmost attention. He died. Same case, same thing. Okay, now surrender value is 20%. Tell me, how much will you credit to P's account on P's death? Please take your pen and paper. Please do the calculation and arrive at the amount that you will credit to P. And assume for a moment P's share is 1/2. 1/2. Same question. There are three policies, 25, 25, 25. JLP is shown in the books at 15,000. P died, surrender value is 20%. P share is 1/2. How much will go to P?
The 17,500.
17,500.
7,500.
7,500. Others? It cannot be 17,500. No, 17,500 to
22,500.
No. See this, no. JLP was shown as asset in the books at 15,000. You have ignored this fact. Yes. Think calmly. Think for 2 minutes. I have already told you what is to be credited.
Sir, 10,000.
10,000. Okay. Others? Others? 10,000, 17,500, 32,500. Okay, Ashwin says 10,000. Others, where are others? Yaar, chale gaye kya? Are you still there or left? Okay, someone on YouTube 22,500. No, it's not 22,500. 7,500. So let us see how does it work. Okay, I just twisted the question slightly. Now I've already told you the logic. On the asset side, we have JLP at 15,000. Okay, so when you open the JLP account, you will have to balance brought down 15,000. Right? How much amount will you receive by bank? 25,000 you will receive from whose account, or because P has died, you will receive 25,000. That is one thing. And you will receive surrender value 10,000. So total amount is 35,000. This side you have only 15,000. So to partners capital account 35,000 minus 15,000, 20,000. So
20,000.
20,000 divided by 2, 10,000 goes to P's account. Then balance will go to Q and R, whatever is the ratio. Are we clear? So see, the way you have to understand is JLP in the books as an asset is at 15,000. And the value that we will get when we surrender the policy and when the partner dies is 35,000. But I have already recorded 15,000 of asset. Against that 15,000 of asset, I am getting 35,000. So what is my gain? 20,000. Out of that 20,000, P will get half share. Are we clear?
Yes, sir.
Any doubts?
No, sir.
No,
Are we
sir.
clear how we got 10,000 for this partner?
Yes, sir.
Others, I want yes from, at least type it out if you are out somewhere in the library. So basically you have to compare the asset versus the amount that you will receive or that you have received. Okay. So one more time. Asset in books is at 15,000. Value of policy is 35,000. How is this 35,000? 25,000 received in cash or bank plus 10,000 surrender. Okay, what is the gain? This is the gain. So P will get 1 by 2, which is 20 by 2, that is 10,000. Okay, now coming to the other aspect of goodwill, where we had left one specific topic on the other method of computation where we have to adjust compute goodwill. Now for this I want to tell you an underlying fundamental logic. If you understand that logic, then solving questions on these category in the exams most likely they will not test. Okay, they used to test this at final level. It used to be really difficult when we had to value goodwill of companies. Okay, even if they test, they will not test you at a very difficult level. The thing that you need to understand in this thing is where you have to do some adjustments in profits is goodwill is something which will give superior profits in future. That is why we say it is goodwill. If it does not give us superior profits, where is the goodwill? Right? Now, while calculating goodwill, we said we will use profit method, average profit, this profit, that profit method. But sometimes what happens is those profits amount are distorted. When I say distorted, there could be one-time event. There could be a one-time event. There could be a one-time profit. There could be a one-time loss. Now, will those one-time profit or one-time loss reoccur in future? It will not reoccur in future. Let us say this year, there was, because the stock market went up, just for example, stock market went up, we had investments, we sold off investments, and we got huge profits. Will we get the same profits in the future? We will not likely get the same profits in the future. So, we should ignore those items which are one-time or which are exceptional in nature while calculating goodwill. Or say for a moment, in the future, we expect that the expenses will go up by some amount, okay? Or we have to pay additional salary to some manager. Now, such items will reduce our profit in the future. So, what we have to do is we have to calculate future maintainable profit. Now, when I say future maintainable profit, what we mean is the value of profit that can be maintained in the future. It is not based on one time. See, there can be a one-time loss also. Loss due to fire, loss due to theft. Will those items occur again and again in the future? They will not occur again and again in the future. And hence, you will not consider those non-recurring items when you calculate goodwill, right? So, let me open one question from the practice part, and then we will solve that to understand this. Okay, so let us. Yeah. Wise, clever, and dull were trading in partnership, sharing profits and losses 4:3:3. Okay, that is what is given. Fine. The accounts of the firm were made up to 31st of December every year. So every year, 31st of December, you make the account. Is there any adjustment in this? Yeah, there is an adjustment.
Sir,
Yes.
but I think illustration 11 has almost a comprehensive
Yes, sir.
adjustment.
Illustration 11. Yes, sir.
Okay, we'll cover illustration 11 then. That is better.
Unit 2.
This one? CU and AU. You know what CU stands for?
Copper.
Copper.
Sorry, copper, somebody said? Copper, yeah, it is correct. Copper. These
Yes,
are.
sir, I said copper and gold.
Yeah, CU stands for copper. AG also stands for some element. Okay.
The A for gold, I think so.
AU is gold, maybe. Yeah. AU is aurum. I don't know. Anyways, okay, they take some planetary names. In final, you will see all Sun, Moon, Jupiter, and such kind of questions. So AU is aluminium, maybe. Yeah, could be. AL also could be aluminium. Anyways, ours is a foundation exam, not a science chemistry exam. It's fine. So C and A or CU and AU were in partnership, sharing profits 5:3. On 1st April, they decided to admit AG. The partnership AG into the partnership on following terms. AG will bring 2 lakhs capital for 1/4 share. Okay. NPSR will be 2:1:1. Okay. CU was entitled to salary of 2,000 per month. Just a second. There are someone. CU was entitled to salary of 2,000 per month. It was revised to 3,000 per month from 1st of October 2018. Okay. So we'll see how does it impact. Interest on capital was paid at 8% per annum. Okay. Capital as on 31st March were 4 lakhs and 3 lakhs, which had remained unchanged since last 4 years. Goodwill was to be valued on the basis of 3 years purchase of average adjusted weighted average profits. So basically 3 years purchases of adjusted weighted average. There is nothing called average adjusted weighted average profits. Okay. The profit of previous 4 years before charging interest on capital and salary to CU were as follows. So 210, 260, 210 and 305. That is the profit. Okay. Then the profits were subject to following rectification. So there are some rectifications which we have to do in the profits. Machine costing 40,000 purchased on 1st October was wrongly charged to revenue. Now, what is the meaning of wrongly charged to revenue?
Wrongly charged to P&L expense.
So you purchased machine. What should have been the actual entry?
Machinery to cash.
Machinery to cash. What did we do?
Purchases to cash.
Purchase to cash or expense to cash, which means profits were understated by 40,000. Now, if we had purchased this machine on 1st of October and if we had rightly capitalized this machine, then what would have been the impact on the P&L? See, one is 40,000 on the purchases or expense side, you will reduce. What will happen on the other part, or what will be the other impact if you capitalize this machine?
So the depreciation of 20%.
So one, you have to capitalize it and show it in the asset side. And second, you have to depreciate this machine at 20% per annum. Okay. Now here, what have they given? It is April to March. So will we charge 20% or will we charge less? Because the machine is purchased on 1st October.
Let's not wait. April, May, June, July, August, September. 6 months.
Oh, you don't count from April. You will count from October.
Sorry.
In exams, you count from wrong month. You are gone. You purchase on 1st October from, see, this is 1st October. Okay, 6 months, 6 months, 6 months this side, 6 months that side. Otherwise, October, November, December, January, February, March. I'll tell you, many students, they, whenever these dates are given, no, 1st October, 1st November, there is an error which happens. Most of the times, they, students tend to take 1 month extra, 1 month less. Say, for example, this is 1st October. Instead of that, it is 31st October. They'll start counting from October. So please be careful while counting the months. Okay. So machine costing 40 was purchased on 1st was wrongly charged. So you have to increase the profit. Then you have to charge depreciation. Okay. Stock on 31st March was overvalued by 20,000. Now, what is the impact in 2018 P&L?
Profit would have reduced. Sorry, increased.
See, don't be in a hurry here. Don't be in a hurry. Think and answer. Exam may also don't be in a hurry. Think and write the answer. 2018 financial year. Which financial year?
2018.
17,
17,
19 or 17, 18?
17, 18.
So 17, 18 stock is overvalued by 20,000 means what? Credit side is more by 20,000.
Or yes.
If credit side is more means profit is more or less?
More.
Profit is more. So now you have to reduce that profit. Okay. Then what will be the impact of this on 2019 P&L?
Opening balance also would have been increased.
Opening stock would have been at a higher amount. Then what will be the impact of that?
Profit would have been decreased.
Profit would have been decreased. Now you have to add back. Very simple. Are we clear?
Yes, sir.
Okay. Then.
Sir, but
Yes.
Sir, but would that both to cancel out and noise should be made to adjust?
Sorry.
The same 20,000 of profits will occur in two. One side it's a loss and one side it's profit. So wouldn't that cancel out each other, sir?
They will cancel, but what will happen is, if at all you have to apply weighted average profit method, that is what the question says, no? Weighted average profit. So the weights will be different.
Okay, sir.
See, profit in 1 year is higher, profit in next year is lesser. They will offset each other. That is fine. But for calculating goodwill, your weights will change because you will assign weight of 2 year and weight of 3 year. So that will make a difference. That's why you have to change it. Okay. Then
Okay, sir.
there was a loss by fire amounting to 10,000 in year 2016-17, which was not considered in trading account, but correctly debited in the P&L account. So what will we do with this? Will it increase?
Overvaluation of stock, I think, closing stock, I think.
Correct. Or you can say from purchases, so much of amount had to be reduced, that was not reduced. So it is understated. Okay. Because you have debited. What you have to debit to the P&L, you have debited. But what you have to credit to the, inventory account, or what you have to credit to the purchase account, that you did not do. So the way to understand these kind of adjustment is, let us say you made purchases of 1 lakh. Okay. Out of this, stock worth 10,000 destroyed by fire. So what you have to do is, either you have to reduce it from the purchase minus 10,000, or you have to credit saying by loss due to fire 10,000. Are you getting it? Because it is not a trading item. Something which has been lost due to fire is not a trading item. And this loss, again, you will come back here and say to loss due to fire 10,000 in the P&L. So one item is you will credit in the trading account, credit side. Same impact, because it is a loss, you will debit in the P&L. So the question says P&L is correctly debited, but the trading account impact is not given. So now you have to give the impact of trading account. And they say adjusted debtors as on 31st March of 2020 included bad debts of 5,800. So you have to write off the bad debt.
Sir?
Yes.
Sir, it is if it's not given the impact in trading account, then would that reflect in the next year's trading account also, sir, in 2017-18?
No. So it will not come, because closing stock is physically counted and put in the trading account.
So did they mention, sir, like that?
No. Generally, that is how it works.
Okay.
So you don't have to show the effect on next year's profits.
No, you don't have to show it on the next year's profit, because P&L loss you have booked. The inventory valuation, see, generally, even if you see the inventory chapter, you will find physical stock was taken on this date. We have those questions, right?
Yes, sir.
Correct. So generally, see, they may not take physical stock on 31st March. That is not the case. But in most of the organization, closing stock is valued based on the actual physical verification. Are you getting it?
Yes, sir.
So what happens is, I'll just explain this concept once again to you. This is my trading. This is my P&L. Okay. Say for example, there are no opening stock. There is purchases 1 lakh. And there is no sale. We did not sell anything, just for simplicity purpose. But there is a loss due to fire. That loss due to fire, we did not give the impact in trading. Then what did we say? By closing stock, because 10,000 of goods are lost, when we physically counted, we will get only 90,000 worth of goods. So we'll say by closing stock 90,000. So what will happen? Here you will have a loss 10,000 gross loss. Okay. Then in the P&L you will say to gross loss 10,000. And again you say, there is a loss due to fire. Let us debit P&L. So to loss due to fire 10,000. So impact got double 20,000. So what you do is, whatever is lost due to fire, you credit to the P&L account. Remember the abnormal loss treatment in consignment account?
Yes, sir. Credit to consignment.
Credit
Yes,
to consignment, same way. This stock is lost. Stock is lost. So loss due to fire, you will credit here 10,000. When you credit that, there is no gross loss. When there is no gross loss, only this 10,000 of loss will be there. This is the logic. Clear?
Yes, sir.
Okay, so now let us, these kind of questions prepare in a tabular format in this way. So 16, 17, 17.
So that is like you have reduced from stock. Otherwise, you can even like you have credited by loss due to fire. So otherwise, you can reduce from purchases also. No?
Yeah, you can reduce from purchases. This side also you can do. Either ways you can do. For adjusted purchases also can be done, or credit side also you can do. Both of them.
Okay,
I'll tell you one thing, guys. When you start working, all of these concepts are important. I'm not saying no. Okay. But when you start working in ERP system and all of that, this trading account, P&L account, you'll find nothing. There'll be a simple statement of profit and loss. That is the single statement that you'll be preparing. Okay. And things that will happen is, you will not say purchases to creditor, you will say inventory to creditor and cost of goods sold to inventory. When you come to interlevel, CA intermediate, we'll understand those concepts in detail. Don't worry for now. But a lot of things that you learn at foundation, the reason why I'm telling this to you is, don't try to overspend time in perfecting things. Some things are not relevant today. Okay. Some things are, nobody prepares cash book, 3 column, 2 column, nobody prepares cash book. You simply have cash account. Okay. So, and this journal proper, bills receivable book, all of those things are, those are only theory based. So what you have to do is, concepts be strong. I'm not saying ignore the concepts, be strong in concepts. Some things, which do not require so much of time in mastering the logic or understanding the, why is it like this, why is it like that. At some places, try to go with the flow, try to just understand, aisa hota hai, this is how it works, and please, write your exams. Because if you try to do more and more perfection, research thing on those items, then it will hamper your preparation. Okay. And when you actually start your audits as article students, or when you start working, you will realize that what you learned, concepts is fine, you have to be solid in concepts, but lot of these statements, in fact, I have never prepared a consignment account. Okay, BRS is very important, inventory is very, very important, rectification of errors is very, 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 very important. Okay, but I have never prepared consignment account. I have never prepared, share capital entries will be only 1 or 2. Okay, when we floated the company also, simply issue the shares at a single shot, 1 entry done. Okay, so some of those things are good for knowledge purpose. So you have to see how much time you want to spend when you are actually preparing your, accounting, or for that matter, mathematics. We have some students who want to do PhD in mathematics. How did this formula come? How did that formula come? Some things you just remember the formula, write the exams and forget them. Today, if you ask me derivatives, I don't remember the formula. I just remember basic derivatives formula, because never ever used in career. Okay, so that is one thing you have to keep in mind. But yes, when you read law, read the sections properly. When you read FM, financial management, or all of these things, these will be really important. And some things which are not very important, you just try to read it, understand the concepts, and prepare for the exam. Okay, now coming back to the question, 16, 17, 18, 19, 20. So 210, 260, 260, 210, 305. These are in thousands. Okay, profits. Now the question says what? These profits are before charging interest on capital and salary to the, who is that? CU, copper. So before giving salary and before charging interest, this is the profit. Okay, now how much is the interest on capital? Interest capital is 8%. Interest on capital is at 8%. Now, when I am preparing or when I am charging interest on capital, should I charge interest on 8% at only for 4 lakhs plus 3 lakhs, that is 7 lakhs, or should I charge interest on capital on 8, 4 plus 3, 7, 7 plus 2, 9 lakhs? I want an answer for that. Is my question clear? Should we charge interest on capital only to the old partners or also to the new partners?
Old partners.
Because we are talking about profits of the past. See, when the new partner gets more capital, then we will earn more profit in the future with the extra capital. So, but now we are calculating profit impact for the previous period where capital was only 7 lakhs. So interest on capital, you will say 7 lakhs into 8%, 56,000. Okay, that is first. Then salary. CU was entitled to a salary of 2,000 per month. It was revised to 3,000 per month from 1st of October. So salary. Here it is 2000 into 12, 24,000. When was it revised? 1st of October. So this also will be 24,000.
There 30,000.
Here it will be
30,000.
2000 into, when did they revise? 1st of October. So till September means 6 months. 6 months plus 4,000, 3,000, sorry, into 6 months, 30,000. And here it will be 3,000 into 12 months, 36,000. Okay. Then capitals is done. Goodwill is to be valued at 3 years purchase basis. Okay. Then machine costing 40,000 was purchased on 1st of October, wrongly charged to revenue. Machine purchased. Machine purchased when? That also purchased on 1st of October. Okay. So 1st of October means 1st of October means this, right? 1819. How much? 40,000. Add 40,000 less depreciation. How much? 40,000 into 20% divided by 2, 4,000. Correct? What will be the next year depreciation?
So 7,200.
7,200. How? 40,000
40,000 minus
4,000 into 20%. 7,200. This is 40,000 minus 4,000 multiplied by 20%. Because the question says written down value method. Okay. Then stock on 31st March 18 was overvalued by 20,000. When the stock is overvalued, 31st March here, overvalued means profit is higher. Now profit has to be lower, which is by 20,000. And here profit is lower. Profit now has to be higher by 20,000. Okay. There was a loss due to fire in 1617, not considered. So here you have to add it to the trading account, 10,000. Debtors on 31st March include bad debt, 5,800. Okay. So what is the revised profit?
Sir,
Yes, sir.
so for that, the depreciation for the year 1920, you left that negative symbol. So
Oh, thank you. Thank you. Okay. So this is the profit 140, 160, 180, 2 lakhs. Now what I have to do? 1, 2, 3, 4. Weighted means you will start with one from the last year and calculate the weighted average goodwill. So right, that you can do. There is nothing there. And then adjustment, you can, as I told in the previous class, you can raise in the old ratio, need not calculate the sacrifice ratio, raise in the old ratio, write off in the new ratio. Okay. Now here the question says that goodwill will be brought in cash. So you will debit bank and credit to the partner's capital account. You can first debit bank, credit to the new partner, then debit the new partner and credit the old partner. That is also fine. Right. So this was about goodwill. We covered largely the various aspects of admission, retirement, death of the partner. I am not covering, transfer to loan account, calculation of this loan account and all of that, because those are simpler things that I think you are comfortable with. There should not be any challenge in doing that. And we have seen some past exam papers where we saw not much of a complexity is tested, even if, the question may appear complex, but you will be able to solve that, right? So we conclude partnership with this. Then what do you want me to start in the next class? That is Friday.
Consignment.
Consignment, I will sorry, consignment others.
sir, I have a doubt in partnership accounts.
Okay, tell me.
So can you reiterate that thing about you said about workman compensation fund? Last class you said, but I couldn't get it properly.
What was that? Provident fund or compensation fund?
So yes, sir. What's the different Are there different treatments for both of them?
No. So see, what you have to understand is, one thing is it is sad on the part of institute also, because provident fund and all you are not yet exposed to. They should test those questions at CA inter level. Okay, but still, see, there is a fund. Generally, fund can be of two categories. One is the owner's fund. Other one is related to liability. Owner fund means what? Say for example, reserve fund. This is belonging to partners. Okay, or they may say general reserve. This is belonging to the partners. Or sometimes they may say building fund. Sir, how did building fund come in partnership? It should come in NPO. No? Even in partnership, you can have building fund or building reserve, where they keep aside some amount which they will not withdraw, and at a future date they may withdraw. This also belongs to the partner. But then, if it is something to do with outsiders, for example, workmen compensation or employees provident. Provident fund is a retirement fund. Okay. No need to again do a lot of R&D onto this. If it is a fund related to outsiders, then these are liabilities. So you have to treat it as if it is a liability. Is that clear?
Yes, sir. Because in our 12th materials, it's given we should distribute workman compensation fund, so that the confusion I asked.
Sorry.
In our 12th material, it is given we should distribute workman compensation.
See,
fund, so
okay. So if there is no liability towards workmen, so say for example, if there is no further liability towards workmen, you don't have to pay anything to the workmen, then you will distribute it to the partners only.
Yes, sir.
Okay, so it depends on the way the question is structured. Employees provident fund payable, you have to pay to the government, so this cannot be escaped. To the workmen, I say, okay, I have created some fund so that I will pay amount to the workmen in the future, and now later on there is no requirement to pay, then that money will remain in the firm and that will be credited to the partners itself. So that you can make an assumption. You can say workman compensation fund is assumed to have been continued in the firm. Or if the question says, no, the fund is no longer required, then you will transfer it to the partners account. Clear?
Clear, sir.
Okay, so next class, what do you want me to take? Somebody said consignment, others?
Sir, I think before consignment, you need to do once inventory, like they are interrelated. Sir.
Okay, inventory. Then any other? Rectification was one. BRS, are you guys comfortable?
Yes, sir. I don't think
BRS is comfortable.
Okay. So consignment, I will not do immediately, because if I do now, again, you will forget before the exams.
Okay. No.
Okay. So first.
Those both you can take later.
Sorry?
I mean, like inventory and consignment, you can do it last.
So what we'll do is we'll do rectification one session, then maybe inventory one session, then we can do consignment, then we can do maybe company's account for feature and all if you have some doubts on that.
Okay, sir.
Okay, death of a partner, practical question 2. So today it is getting late. I will take it up before we start in the next class when we start rectification. Before that, we'll quickly go through the question and we'll discuss that, Fatima. Okay. So what do you like? Is it better on YouTube or better on Zoom?
Zoom, sir.
So I think for me personally, it's better on Zoom, sir.
Okay. Everyone is comfortable with Zoom? Okay. So we'll continue on Zoom. Once in a while, we may do on YouTube, because other students also would want to join on YouTube, right? So whenever that is on YouTube, we'll let you know. We'll do it on Zoom. Prepare well, take rest, have a routine, follow a routine. Okay, that is one thing very, very important. Have a fixed waking up time, fixed sleeping time. Okay, and fixed time to have dinner and all that. Follow that routine. Don't one day I'll get up at 6 o'clock, other day I'll get up at 10 o'clock. Please don't do that. Don't overstretch yourself. Give easily 8 to 10 hours of studies in this period is also fine. if you have something more left, you can do 12 hours also, but don't overstretch yourself. And social media, please try to start avoiding from now. Okay, because what happens is you open a WhatsApp message, then in that WhatsApp message you'll get a YouTube link, then you'll go to YouTube, then in YouTube you will start watching one video, then another video, then another video. Please don't do that. Have limited time with your social media profiles. Stay away from distractors right now who will say that it's not happening, it is getting difficult, I'm not able to understand, and all of that. Please stay away, because I used to really find difficulties in handling people who used to call me every day and say, "Arey Suraj, this is not happening, that is not happening. Focus on your preparation. This is your journey. The way you write the exams will decide your result." I'm not saying don't help the students. Definitely help the students. But then if somebody is distracting you too much, please avoid. Okay. Chalo, see you in the next class. Next class we'll have on rectification of errors. Any tricky question, any complex question you can want, you can send the mail to support ID, and I'll take a note of that and I'll solve it in the class. I'll also try to get some, I'll try to create my own complexities, and I'll help you understand that. Right. And also this partnership, if I forget, please remind me, Fatima, to take this second question. Right. So nice chatting with you guys. Want you guys to be more interactive, more talking in the class. Okay. This is not a typical 12 standard setup. You can feel free and you can chat with me. That's not a problem. Chalo. Okay. Take care. Bye bye. Have a nice day.
Bye, sir.
Bye.